The risk rate is 8.7%. The firm's beta is 1.5. That means high risk company. And return on market is 11%. So with this, we can simply find the return on the or required return on the common stock, which is 7%. Risk rate plus beta into RM minus RM. So it is around 13%. But remember one thing, it's almost same when what we got with the GGM for the largest company, right? So there also, it was around 13%, same number. But please note, usually when we try to find the discount, the required return on the cost of equity with GGM and CAPM, there will be sometimes quite some difference. But we will hardly find them. Really, we are going to see them to be almost same or exactly the same thing. So if you see difference in the discount rates, also in the cost of capital, from these two methods, that is expected, not a big deal. But in that case, which should be used for our assessments or for the calculations? That depends on the certain factors. One of the most important factors is, say, if you look at say the GGM, in that case, the growth rate, for example, is something that we derive from the growth of the company over time. Is that growth reasonable or not? And most important part, if you can recall, we have the R minus G in the denominator, right? Suppose for high growth company, there's a possibility that G can be more than R. High growth companies can have more growth than the discount rates. That means we are going to a negative denominator. In other words, we are going to a negative return. That's not going to happen. So it's all about you have to more like think logically and make the decision about or take and we'll have to make our own judgment about which of the two we are going to use for the assessment. But calculating both is very important so that we get idea about so how we can proceed with the things. Remember, when we look at the CAPM, it's purely based on the market, right? And the relationship of the company with the market. If you see here, none of the components comes from the company except for 1.5 in the beta. This also is in relation to our market portfolio. Remember, the beta we get as if you look at this one, this is typical regression equation, right? See here, y is equal to, right? And this beta is here. X is nothing but RM minus RL. And our A is RL. The relationship out here, right? Relationship between two variables. In this case, two variables are the return on the company and the return on the markets, right? Because remember, we say that all the assets, all the companies, all the stocks are component of our market, and you look at the relationship between this individual component of the market and our market. That is what is the beta thing. That's why this is usually considered to be more reliable measure for finding the cost of equity. All right. Well, here are some same thing is mentioned here. We say the CAPM technique differs from the constant growth valuation model. In that it directly considers the firm's risk and depended by the data in determining the required rate of return or cost of common stock. The constant growth model does not look at risk. That's purely based on the returns, right? The dividends, the price, and the growth rate. It uses the market price as a reflection of the expected risk return preferences of the investors in the marketplace. Remember, normally we say the price should be based on the two dimensions, risk and the return, right? The price of the security or any asset should be based on the expected returns and the risk involved there. So that's why you say the directly it doesn't consider risk, but it is true that the risk is captured in the price of the company's stocks. The constant growth valuation and CAPM techniques for finding are as theoretically equivalent, though in fact estimates from two methods do not always agree. That's what I said earlier, right? And if there is a wide disagreement between the two, means the difference is quite significant, then you have to make a pick. We say another difference that is when the constant growth and the CAPM is used is, we say the common stock cost, it can easily be adjusted for the flotation cost of finding the cost of new common stock. The CAPM does not provide a simple adjustment mechanism. So again, remember we said if we are supporting the securities, we've been including the cost of flotation, right? Like usually called underwriting costs. So in that case, we cannot ignore that important component of the cost. Because remember, in case here, the more reliable, or you can say more, you can say relevant method will be in that case, the GGM method, not the capital method. Again, it can be reducing cost of common stock. Say equity developer using debt occurs because in its common form, the model does not include the market price PO, a variable needed to make these certain steps. So obviously there is no P0 or price anywhere in the capital. So we cannot make any adjustments for the change in price or decrease in the proceeds from the sale of the securities when we are going to say consider issuance of the new common stock or a new lot of the shares. So for the existing ones, common say retained earnings, doesn't matter. But in particular for the new issues, we have to consider the flotation cost. The GGM method is more appropriate for finding the cost of capital. All right. So here is about the retained earnings, which had already mentioned there. What is the problem in there? It's very simple, right? If you are given the three things, you can easily find it out, right? All right, here is something about, say, a matter of fact. This you can read off your own. I don't care much about this one. That's. Oh no, something is important. Yeah. It's a retained earnings and reinvesting earnings. Retained earnings and reinvesting earnings, right? So if you recall, when we talk about the payout thing, and this in the beginning I told you about this one, a company should retain the earnings only and only if they can invest that in value generating projects, right? Otherwise, earnings must be paid out. So if a company is keeping the earnings, retained earnings, then these must be reinvested, right? We said technically if a stockholder receives dividends and wishes to reinvest them in additional shares of the firm's company, he or she first have to pay personal taxes on the dividends and then pay brokerage fee before acquiring additional shares. Basically, this is, please attention here. This is the justification for, say, retained earnings, not paying dividends, or we can even say why people prefer to go for investment in the stocks, which do not stocks and companies which do not pay dividends. Pay dividends. You will see around 50% or more of companies do not pay dividends in any market. And we say that the returns or the what you call as reward for the stockholders is the dividends they get, right? But it depends upon the people who are investing. For example, young professionals, they are investing for retirement, for example. They need money after many years, 30 years, right? So for them, if they keep on getting money in the form of, let's say, coupon payments or in the form of dividends, that is treated as their personal income and they have to pay tax on that. Right? So if you do not get the dividends, basically you are not going to pay tax, right? But your money will automatically be channelized or invest in the new projects, right? Technically, it is automatic investment without having to incur any cost, no taxes, and no brokerage fee. Right? So this is justification for serious. But you see this was well done.
Which fee and donation cost?
No. Brokerage fee is different. Brokerage fee is for the individuals, not for the companies. Now think, for example, we say, I said from the perspective of the investors, why they would like to invest in the company that do not pay dividends. We can flip that and we can say why companies can retain the earnings without having to see the reaction from the investors, or investors will be okay with that. Because as an investor, if they do not need money, once they get the dividends, they are going to reinvest everything, right? Because they're not needing it right now. They need inclusion. So what will happen? Once they get the dividends, they have to pay taxes. Cost number one. And number two, when they channelize the same money and invest one more time, they go through the broker, right? They will have to pay the brokerage fee. Investors, not the companies. Right? So that's by using PT as the average stockholder personal income tax, it's more like how you're going to get, for example. Now think about the return for the individual investors. Suppose if I get my returns, so it's going to be cost. My return is, but this is my return as investor, right? Rate of return they call. I have to pay tax on that, right? Suppose think here, the return was say 12%. And assume my tax rate is on this as others can also see. For the sake of argument here, we say by using the PG as average, says shareholders percent tax rate, and BF as the average brokerage fee state as percentage, we can specify the cost of retained earnings. The retained earnings for who? For investors, not for the company. Remember, we are talking about this time, we are kind of going on to the side of the investors. But if you look from the perspective of the companies, that is what we are stated now, RS for the company. Remember this RS, please know, this RS is the cost of equity for the company, right? But remember, when we say cost of equity for the company, technically we are saying cost of for those who are investing in equity of the company, right? Technically, we can say for the equity holders, but from the perspective of the company. But as individuals, if we get the same thing here, suppose if we have this one, then the cost will be nothing of so when we say cost of equity, that means this money or this percentage of earnings, the company will have to pay to the owners as their compensation for investing in the company. Think about issue for a minute. The company pays our dividends equivalent to the cost of equity for the company, like the dividends or like the coupon payments. Make an assumption here, right? Then how much is the cost for the investor? Or we can simply say, here cost of capital, technically we are going to say, what will be the required rate of return? In reality, how much is a person going to get? If he receives, for example, the return equivalent to cost of equity from the company. What will be the real return? Think this way, suppose if cost of equity is say 14%. Suppose tax rate for the person is say 30%. And assume the brokerage fee is going to pay is say 2%. What is his actual cost of capital, or we can say in terms of his return on this one, not cost of capital earnings. Will be nowadays will be equal to 14 into 1 minus 3 into 1 minus. Right, you can find it. You can 14, no problem. Can you 14?
Percentage.
That's fine, we can take 40%, right? It's 14%. No need to 0.14 here. 14% into 0.7 into 0.6, more like here. 14 into 0.7 into 0.98. So you see the number. It's only for us as additional information. Now, let's come to the actual cost of common stock when we talk about, say, issuing the new stock. We say the cost of new issue of common stock, or N, is the cost of common stock net of underpricing and associated provision cost. New shares are underpricing. The stock is sold at a price below its current market price. Underpricing means it makes sometimes sense. See, if we say the price per share, or normally we say the value of company, depends upon two things. Please note. Now we say value of the company is equal to price into number of shares outstanding. And this value normally we call it market capitalization or market cap or MCAP. Capitalization. Price per share here divided by the number of shares outstanding. Remember, we said the objective is to increase the value of the owner's wealth, right? So this market capitalization is basically on overall owner's wealth of the company. It is combined wealth or worth of the investment of all the investors in the company. That's called a market capitalization. Price per share into number of shares outstanding, right? Now think for a minute. Let's assume for a minute, price per share of the company is say $10 and the number of shares is say 10,000. So it's market cap or cap or something. So now we can flip it. If we know the overall market cap, we know the number of shares, we can find the price per share, right? Now think for a minute. Keeping everything else, I had to make this statement very important, ceteris paribus. Keeping everything else constant. Now assume this company plans to issue a new lot of, say, 1,000 new shares. It plans, or it's supposed plans to issue new 1,000 shares. Keeping everything else constant, means everything remains the same as you have right now. What will be the price per share of the company after the issuance of the new stock? What do you think? How? So how do you get 1,100 then? How? Do it, calculate. Not possible.
I think it will decrease.
Okay, can you calculate, please? Come on, Akash, take it. Do it. Okay, how much less? Find it. Why are you asking me? Find it and say it is less. Be confident. Say it's going to be the pardon? MashaAllah. How? Huh? How? Okay, $1, but how? You cannot make abstract things. It's pure mathematical problem here. Everything is given here. Exact numbers you should get. Ahmad, you got it? Anyone else? Now see, it's very simple. We say M cap is equal to price into number of shares outstanding, right? We say nothing changed, means M cap is same as it was earlier, right? It is 100,000. Price we have to find, number of shares initially was 10,000. That is going to be 11,000, right? It's very simple, there's no rocket science in it. 9 point something, right?
It is not the name.
At 8, right? The new number of shares is going to be 10 plus 1 is 11,000. So it's going to be 9 point something, whatever. That's what I mean by normally we say, normally we believe that if it's under the condition, theoretically, if nothing changes, then the price of the stock should go down because we are going to see an increase in the base over which we are going to distribute the value of the company, right? Base is number of shares outstanding. Same value, larger denominator means lower value, right? That's what happened here. Suppose the value doesn't change and we see decrease in the price. That's what's assumed the underprice. But in reality, it should not happen. Reason for that is, if we believe in the basic logic or basic premise that where we say that a company should raise funds, financing issues, or we'll talk this one, they should only raise money if they can invest in value creating projects, right? So that means it's believed that this additional 1,000 or money raised from the sale of the additional these 1,000 shares will be used in the projects that will enhance the value of the company. Means overall value of the company after investment should be more than the combined value of the existing company, investment of the new, or the new investment, many ways from the new issues. So that way, market is going to react positively if they believe in the company's prospects, then the value will automatically go up beyond $10. But keeping the constant, assuming nothing happens like that, we can expect it to be underpriced. Then obviously, new shares underpriced because this thing. Second part is when you're going to sell the shares, you will incur the flotation cost, right? Registration, administrative cost, as well as underwriting costs. So we will have to chip in or bring in these two things in estimating the value of the new issues. So here we go. That's so earlier we used P zero here, right? Now you're using proceeds. D1 again, expect dividends 1 year from now, divided with net proceeds plus the growth rate, right? So here is, I think we talked about this thing already, so let's not go with that one. Here is an example. We said to determine its cost of new common stock RN. Dutchess Corporation will estimate that on average, new shares can be sold for $47. Remember, it was initially selling for 50, right? When we talked about the valuation of the economics, that time we saw that the market price was $50 per share. Then we see the whole for the new shares, they will be selling them for 47, right? This is more like underpricing by $3, right? The $3 per share underpricing is due to the competitive nature of the market. A second cost associated with the new issuance flotation cost of $2.50 per share that would be paid to issue and sell the new shares. The total underpricing and flotation cost per share or therefore 5.50, right? So basically, we are going to say here, think this way. We know the P0 on that side. Let's try to find the net proceeds for this company. So the current market price per share is $50. Right? Then we have 100 prices. For new shares is $3. Means new shares cannot be sold for 50, they will be sold for 47, right? Right. That's more like we can say here. SP of new shares is $47 per share. Then we have flotation cost, which is $2.5 per share. So what's going to be net proceeds? Net proceeds will be the price at which we can sell the shares, $47 minus the flotation cost. No need to keep right the 5.50. You can avoid all those. We can keep it simple. Simple thing is take the selling price of the new shares, subtract from flotation cost. That will be the net proceeds for the issue from the issue of the new company, new shares. So we get some new proceeds and N will be 47 minus 2.5 is 44. Right? And if you can recall in the previous class, in the previous slides, it was given D1 is $4, right? D1 is 44.5 is the net proceeds. And if we can recall, the growth rate was 5.05%, right? Or just 5%. Now we have all the information available with us. We can find now cost of new issue, that's Rn is equal to D1 divided by Nn plus G, that is 4 divided by 44.50 plus 0.0505. Now we can find the value. How much is that? $13.99, right? We can say 14. It was 13 earlier, right? And we have additional 1% increase in the cost of equity because of underpricing and the flotation cost. Make sense? Any questions? Anyone? No questions? Good
Yeah,
sign.
I
Let's
think
move
so,
on.
yeah.
1% extra cost, 14% per share.
For new ship.
Oh, no, 14% is cost of equity now. Simple. Equity. Equity comes the same thing, right? Cost of common stock, new issue, it's with main issue, this one, the cost of equity for years. It was 13, remember now see the difference, please. The difference between the cost of retained earning, cost of new shares. Retained earnings was 13%, right? But for the new shares, it is 14%. Reason is 1% extra cost because of the lower price that you are going to sell it under pricing plus flotation costs, which were not there in case of the retained earnings. Now that again, reason you can see why companies would like to keep the earnings with them. Remember, if there is an increase in the cost of equity, that has indirect impact, or that directly reduce the price of the shares in the market. Recall, see, just remind about the price per share. We say P0 is equal to D1 divided by R minus G, right? If these two things remain constant and if R increases, that's here. If R goes from 13 to 14, it increases, P is automatically going to go down. Right? So we have, that's why companies plan about, say, that's why they always say before they distribute the money among the shareholders, they are going to look into what opportunities they have for investment future, then only they will declare the dividends. Otherwise, they are going to say that's the money with us. Make sense? That's the more like that understand why. Why is the most important part here? Okay, last part is weighted average cost of capital. Now we have suppose three components of capital, where we have say the debt, preferred stock, equity common stock. Then if all the three are there on the balance sheet of a company, then how can you find the weighted average cost of capital? It is more like weighted average in terms of the weights assigned to each component of capital, multiplied by the respective costs of the capital components. So here the weighted average cost of capital reflects the expected average future cost of capital over the long run, found by weighting the cost of each specific type of capital by its proportion in the firm's capital structure. And where do you find capital structure? In the balance sheet. Look at the long-term debt, look at the total equity, look at the preferred stock, and add those up, and then see the proportional contribution coming from these resources. That is how we can find the weight of, say, or the weight of each component of capital. So we are here RA, or sometimes most people see the author slightly WACC, weighted average cost of capital, is equal to WR. I here is for the debt into RI. Remember, it has to be after tax cost of debt, not pre-tax. WI, or normally people write this, you will say, they will write like this one. Most books will like this WD because authors have their own choices. So they will write some WD into RB into 1 minus 2. Then multiply by the next one, WP RP plus WS or S and whatever is there. Right? So it's more like the proportion. Now remember the weights of these three components, WI, WP, and WS, must add to 1, right? 100% of the total 1. So what do we say here? 3 important points should be noted in the equation for the WACC or weighted average cost of capital. For the computation of convenience, it is best to convert the weights to decimals and leave the individual percentages as they are. as I keep on saying. Do not convert the percentage into decimals. Just convert the weights to as decimals. Second, the weights must be non-negative, that's obvious. You cannot have a negative, right? That's more like getting some kind of benefit. And WS must account for all financial costs within the firm's capital structure. The firm's common stock equity WS multiplied by either the cost of retained earnings or by the cost of common stock. This is where sometimes this question becomes tricky. You will have a couple of questions in the problem sets. Where suppose they will talk about the funds required. So there is some unique way of presenting by giving the problems. You can put this way. Suppose we say that's it. Let's put this way. Suppose we say the optimal capital mix or the structure of the company is something like this one. So we say weight of debt is, for example, 0.3, weight of preferred stock is 0.1, and weight of equity is 0.6. Right? We believe that we assume here that this is an optimal mix, means this is the mix at which the cost of capital overall is minimum for the company. That means for financing any project, they are going to use they're going to finance it in the same proportion. 30% from debt, 10% from say preferred stock, and 60% from equity. Now think for a minute. The suppose required investment for the company is $200,000. Based on the capital structure, how are you going to distribute this one here? Like, add one more thing here. Suppose retained earnings of the company are equivalent to now quickly tell me how are they going to raise the funds for this project, for this investment. It's a very generating investment by it. Because you have to say how much will be financed by debt, how much by preferred stock, how much by common stock, and how. Please. Quickly.
Say again, please, doctor.
Do you see the percentage on the board, optimal structure?
Yes, it's 30, 10, and 60, yeah?
30, 10, 60. And required investment is $200,000, right?
Yeah.
And company has retained earnings of $80,000. Now the question is, how are they going to finance using debt, basically in terms of dollars? What will be the contribution coming from for the investment 200,000 from debt, preferred stock, and equity? Done? Okay.
It's supposed to be the same percentage, yeah?
But what will be the debt?
So 30%, 60,000
Okay, preferred stock,
will be 20,000.
20,000, great. And how about the equity?
So 20, 60, 80, 120.
And now this equity is to be divided, right? See, how much do we have in terms, you have to think here, will you have issue the new stock? Yes, no?
No, probably no.
Why probably? You have the number there, retained earnings, how much?
80,000. You
And
have
how
to.
much do you need equity?
Yes. 120.
So we need equity 120, right? So out of this, our retained earnings is going to be 80,000, right? So our new issue will be 40,000. Now, basically, there is a point while doing this thing. If you are facing this kind of situation, then for you, the weighted average cost of capital will be already different formula now. Right?
Yes.
See, what will be the formula for WSCs? Weights. WD will remain same 0.3, right? WP will remain 0.1. Now we have to see the weight of the retained earnings, right? That is how much? 80,000 as percentage of 20 here, right? So that's how much? How much do you need equity? Total required equity is how much?
120.
Amrita, how much is required for equity to finance 200,000? No, why? No, don't say why. It's here. Tell me which one, which number? How much do you need? And how much are you going to finance this with debt? $30,000 of this will be financed with debt, right? Here, 30.
3% of 200.
And how about preferred stock? 10% of this one, right? And how about the equity? 60%, right? But how much equity is at hand? Means available with us. Available is the retained earnings, right? That is here, 80,000. That means it means that we will not have to issue the whole equity. We need to issue only 40,000 of equity as, say, for raising the funds, right? So this is going to be now, retained earning is 80,000, new issue is 40,000, right? So see here, we have weight of debt of, we have to look at this one of 200,000. Debt is 60% of the same 0.3, right? This is again 0.1 preferred stock. If you look at this one here, this is 0.4, right? 40% of the new requirement of the investment will be financed by the retained earnings. And the remaining 2%, 20% will have to be raised by issuing the new common stock. So you will have here weight of new equity or new issue will be 0.2. Now see the difference. Now think about, suppose we had, if you look at the Dutch Corporation here, so right here. The pay attention here says cost of debt is 5.6 after tax. Preferred stock 10.6. Retained earnings 13. New issue 14. We did all these things together, right? Now when you have to find the WACC for this company, so we are going to look at that thing here. This is for, here we assume if we have, ignore this thing, let's focus on down. That's our distribution here. Now to find the WACC for our company with this distribution, we are going to write this way or put it this way. Our WACC will have 4 components, not 3. Remember here in this formula, we have only 3 components, right? Because it is one club number for the equity, this thing. But this has become now 2. It's R, N, right? So because we have R as well as N, so it's going to be for separate for the R, or say for the retained earnings, and separate for the new issues. So 4 dimensions. So it's going to be now here for us. Suppose WACC will be equal to, assuming the weights of the Dutch Corporation or as for this one, say 30%, 10%, 40%, 20%, it's going to be then 0.3 into 5.6 plus 0.1 into 10.6 plus 0.4 into 13 plus 0.2 into 14, and you will get WACC. You have tons of problems for use for practice. So go through the problems, work on them. If you have any issues, now assuming as per the slides here, the percentage of say 40 and this thing WACC is the same way, multiply the weights and the corresponding cost. What we did here, the weights that correspond to cost, but in case we divide into 4 parts, we will have a different WACC in this case. All right, enough for the day, right?
Just one question, Doctor.
2 questions, no problem.
Doctor, so but in reality, I mean, what you said, in reality, it does not happen. Say, for example, a company's capital structure is, like you said, 30, 10, and 60. and they have less returned earnings than what they need for their new project. Will they
Because-
actually like maybe offer stocks or maybe bonds, or will they maybe finance it by debts depending on the project, or will they just follow the capital structure as is, you know?
No, see, what you are saying is the same thing. Suppose you are saying that they have the options, right, of using either say debt or common stock or preferred stock. It is also true that say floating all three types of securities at one time is not going to be cost effective for a company. So they always will have more some kind of what you call as a leeway for this one. It's obviously a very good question. We are saying that this is more theoretical. You want to keep it as it is. But as we know, the flotation cost of launching all the securities can make it prohibitive for the company anyway. But in case we have here, we are already accounting for the flotation for all the risks. That is on one side, but it takes time to get registration. So time is also very important component here. But there is a concept in finance, what you call as the optimal capital structure. Optimal capital structure basically is the combination of all the components in a way that the overall cost of capital is minimized and the value of company can be maximized. This is the reason, or this is behind the whole theory of financing. Remember, we say that whatever decision we take in finance, it should help us to enhance or increase the value of the company. Right? Now, obviously, depending upon the nature of the project, you may have retained earnings as a component of equity, or you may not have it. Both possibilities are there. Suppose you have a new opportunity of investing big time in some new markets, and there's no guarantee you will be having enough, say, retained earnings to finance the company. So you may go for new issue of common stock, or you may even go for the bank loans. Or basically, as I said in the beginning, here we assume that financing is done, say, through the markets. You may issue a new bond, or you may issue preferred stock. But what we are saying, this optimal capital structure concept, which we learn in the next topic, it is important that the company should remain around that thing. It's more like within a range. There is no fixed percentage or no fixed proportion of the capital which we can optimal capital structure, no fixed one.
Yeah.
It is something around some number, right? And it can change over time with the change in the overall market condition, the condition of the company. So, but they will always try to stick around that number. And for that, whichever way they will have to go for, say, issuing the bonds or issuing the common stock also. That's when normally they will issue the bonds and they will keep the earnings. It's more like they always, companies always try to keep the balance of financing from the debt as well as from the common stock. For them, say, raising common stock, very simple, they retain the earnings. Automatically it goes up, right? Equity post keeps on going up. And they can issue the bonds to get the debt. But you will see they are always doing something, mixed kind of financing for their projects. One does not become obvious because that is done internally, other one becomes obvious when they're going to sell the bonds. That is basically, I think, the best answer to your question, sir.
Yes, thank you very much.
Any other questions? No. Then let us stop here. Thank you very much. I need to go home and sleep.
Okay, good night. Good night.
Oh, I had only around 3 hours of sleep last night.
Oh. That's,
I was working on that. Yeah.
okay, good night.
Good night, sir.